Now, Australia's superannuation sector is set to register its biggest annual growth in 16 years, and with the falling Aussie dollar giving the sector another boost. Despite the impact of the GFC, the average fund has added over 7% annually over the past 10 years. That's a great result. For more, we're joined by Jeff Bresnahan, the chairman of Super Ratings. Mate, how are you?
Very well, Peter, thank you.
Do you get out of bed with more spring in your toe when you know super returns are heading where you expect them to be?
I think it makes life a lot easier for everyone and also for the industry itself. But,
Yeah.
you know, we've been through tough times all through the GFC. You know, 3 years ago we started to come out of it with a 9% return, an 8% return. Then last year we saw back to 0.4 of 1%. So I think Australians looked at it and said, oh, we're back to the bad old days. But this year, in the first 10 months of the financial year, 15% is the median result. So,
Yeah.
look, assuming that the markets hold up between now and the end of June, hopefully we'll be somewhere between 15 and 18%. Now, the best result ever recorded by super funds since the introduction of compulsory super was in 1997, which was 18%. The next best was in 2007, just before the onset of the GFC, which is about 15.5%. So at the moment, they're looking very, very good at 15% plus whatever happens in May and June.
Jeff, when we were going through the GFC and, you know, short-sighted, headline-grabbing, grubbing journalists were bagging super,
Yeah.
were you just saying, gee, I'm sick and tired of all these short-term views on something that really is a long-term play?
Look, it's a hard line to take, and particularly for a lot of people that haven't been through, you know, the 87 crash and the 2007 crash and those sort of things, to hold that line and say, hang in there, things will bounce back and the long-term results will start to come back as well. And that's where I think a lot of people are at, and certainly the media. It sells papers, so it's very easy to do. But, you know, you start to look at the numbers now, since the onset of 2007, and the long-term result, as you said, 7.1%. So $100,000 invested 10 years ago is now worth $195,000.
Okay, we've got a chart that actually shows you.
Yep.
So why don't you pull that first chart up, Jeff, and have a quick look. The numbers aren't easy to see, but you got a red line and a green line. It starts at $100,000, right? And the red line is what we're watching, or is it the green line?
No, the bottom line is actually the cash rate. So $100,000
So if you're
invested
playing it safe
in a cash option.
Yeah.
Yep. And you'll see in 2009, the top one is the balanced option.
Yeah.
Yep. So in 2009, they virtually touched each other. So that means prior to that point. Now, since then, and this is the problem with a lot of, for a lot of retirees and those close to retirement, they panicked, they switched to cash, out of balanced into cash. Now, since that time, the balanced options have gone up by about 47%.
Yeah.
The same period, cash options have gone up by about 15.
Okay, let's repeat the numbers. So the starting point, what date was the starting point?
Exactly 10 years ago, so end of March 2003.
Okay, 2003, and $100,000 became?
$195,000 if you had put it in a balanced option, which most people are in, and left it there.
Yeah.
Now, if you were in cash from day one, you would have $152,000. If you panicked in the middle of the GFC and switched to cash, you would have less than that.
So, all right, so all the people who stuck to their knitting, and maybe a lot of Australians, thank God, are so disinterested in super.
Absolutely.
They just it's like being at the casino, just let it roll and ride, and it's actually been a good strategy to believe in the system. Is there anything in this current superannuation system, and let's just ignore the interferences by government, but the fundamental structure, do you believe it's a good fundamental structure?
Look, I think fundamentally, yes, absolutely. I think all of the tinkering that the government goes in and point scoring that they try and do out of it is, it doesn't really change the system that much. What it does is create fear from a consumer's point of view, from an Australian's point of view. Is super worth putting money into? And that's the key to the whole thing. The 9% is not enough. Now, we've mandated to go to 12, and we can talk about that later on, but individuals need to put money into superannuation. They need to trust it.
But Jeff, one of the greatest strategies for people would have been the salary sacrifice right through the GFC, wouldn't it?
Absolutely.
And you might have thought you were throwing good money after bad, but the reality is it would have been a fantastic time to get those write-ups in the superannuation balance.
And if you look at the personal contribution rates by Australians since 2007, since Costello sort of took away some of the options and the GFC, they have gone down by probably 60 or 70%. On their highs. So people stopped contributing.
So they did stop contributing. And so, in a sense, they reacted to all the negative news around the place, didn't believe in superannuation. As a consequence, they've lost out.
Yeah, they stopped contributing. It's interesting, they were paralysed. Stopped contributing, stopped moving funds. So they stopped switching from one fund to another and stopped switching options as well.
Inside that story of people not wanting to contribute, there are some dud funds out there, aren't there? And that's part of the reason why your business existed. You wanted to identify, A, the good performing funds, and B, the ones that don't overcharge.
Yeah, I mean, super, there's no one part of super. You just say, look, that's a good super fund. It is a whole value for money assessment across fees and governance and returns and all that sort of stuff. But the reality is, certain funds, if you had invested in them 10 years ago, you might have 50 or 60% higher balance than invest in Fund B. So that you can have a massive... It's like the simplistic way is to say, do you want to retire with $500,000 in the account, or do you want to retire with 800,000 in the account with the same contribution levels? And that makes people wake up and go, oh, you know what, it is in my best interest to actually look around and see what's best for me, because people don't and they need to.
Let's have a look at the next chart, because that gives us an idea of the performance. Now, what are we looking at here, mate?
That's the annual results of the balance, or the balanced option since the introduction of compulsory super way back in 1992.
So is it like the median fund?
The median fund. Yeah. Obviously, you're going to have higher and lower ones, but that's the median for all of the
Since
funds.
what year? 1992.
Since the introduction of compulsory super.
So you've really only got 1, 2, 3 negative years.
Yep. And all of the 90s completely positive, and this is what lulled us into that sense of false sense of security.
Yeah, because that was ridiculous.
It was, and then we got into the early 2000s. We had 12, 14, 15% returns.
Yeah.
Gee, this goes on forever. Bearing in mind, inflation at the same time was averaging about 3%.
Yeah.
So you were CPI plus 8 or 9%. It's ridiculous. It's unsustainable.
Yeah.
So right now, 7%. 10-year return, CPI at the same time just under 3, so it's about CPI plus 4.
Well, basically, when I talk to clients, I always say to them, look, if you have a good superannuation strategy, you should be looking at about 7 to 7.75% return. And that's what given the fact that the GFC wasn't all that long ago, the fact that it's now bobbed up, that's good. But also, if you go long stocks only, I said, then expect about a 10% return. And the interesting thing is, people complain to me, well, the stock market's up nearly 22%. How come super funds have only done 15? It's because they're a little bit safer, isn't it?
Look, a classic example is the last financial year, international shares lost money, Australian shares lost money. The average balance fund returned positive 0.4%. This year, Aussie shares are up, international shares up. They've gone up with the 15%, but they didn't have a negative year, even though the other parts of the investment did.
So the bottom line is, from our discussion tonight, that there's going to be another GFC. There's always another crash in the market. And people should just stick to their knitting. And in fact, if they've got guts, even top it up, provided their fund is a good fund. And
provided they understand what sort of option they're in. People didn't realise that a balanced option had 55% of their money in shares and another 10 to 15 in property. So if you can't handle that, switch. There's a range of options. It goes from cash right up to unhedged international equities. Make your choice, but take an interest.
Okay, let's talk about the proposition the coalition has put in to delay the rise from 9. Well, we'll probably get 9.25 on July 1
Yeah,
this
that will come through.
Yeah, and they're going to delay the jumps to 9.5. And 10 or 9.75.
Yeah, I think
so. So effectively, by rather than 1919, it'll be 2019. How old am I? And to 2021. So 2 years away. First of all, I've seen 2 sets of figures. Some people tell me if I'm a 30-year-old on 100k, I'm going to be down 120,000. But another one said 40,000. Have you done a calculation? Because I would have figured...
Look, mate, I mean, it's all about the assumptions that are sitting underneath the numbers. So you can make it look at $5,000, you can make it look at 300,000. But reality is, look, it probably is somewhere around 40,000 by the deferral. But if you look at it, there's 2 sides to it. Obviously, it's going to help small business by that deferral. But also looking back at the history of superannuation, it's basically been a trade-off for income anyway. So if the government succeeds in pushing that back for 2 years, then aren't the unions going to step up and say, you know what, we want that extra 0.25%, we'll take it in cash, thanks. So it's not really a win-win situation. So I think, and that's what will happen. And I really can't see any massive benefit to defer it for another 2 years.
It simply is a a way in which the coalition will get $2.5 billion, which they can then show and say we're going to use that for one of the promises that they're going to threaten to take away the carbon tax.
Yeah.
I'm sure that's behind the thinking. But your argument is it's short-term thinking?
It is short-term thinking, and are businesses going to benefit from it, or are they just going to have to pay their 0.25% out in higher wages?
Yeah, OK. Let's go to another issue. When you go to your website, a lot of people say to me, look, I want to know what is the best fund, historically speaking, or even give me the top 10, which you actually do. But then they said, well, I can't easily find out what are the costs of those top funds compared to my fund. Because in a perfect world, you go to your website and say, there's the top 10 funds, here are the costs that they're charging. Oh, that fund's done better than my fund I'm currently in, and the cost is actually... Is that something that is actually findable on your website?
No, we don't actually do it directly, but a lot of the super funds have taken some of our calculators, which you can go onto their site, put in your details, how much you've got in the account, or just compare my fund against your other fund, and it'll show you what the fees are for the two funds and what that will project out to, what savings you can make over 5, 10, 15, 30 years as well. So
basically, if someone really wants to do, and I'm thinking about someone who wants to do their homework on their fund, they basically find out what has been their probably 5 or 7 year return.
Yep, 5 to 7, either one. Yep.
And that gives you a rough idea of how good they have as a performance.
Yeah.
Then you look at their MER, their cost, right? And then they could go to your website and pick out maybe the best 5 on a long-term basis.
Yep.
And then go and inspect and find out what their costs are. Would that be a good strategy to try and...
It would. Basically what we try and do is we rate something like 500 different products, super products across the thing. Only 25% of them are rated with the highest rating. Yep. So what we tried to do is we try and do all the homework for you, try and do all the fees, all the insurance costs, all the returns,
so in your
all the governance.
You actually have incorporated the fees.
Yeah, it's a whole process with 300 to 400 bits of information that goes through and say that is the better value for money fund than Fund B. Yep, and that's all we try and do. So for an individual trying to do it, gets very complex just to do the right thing.
All right, let me put you on the spot, Jeff. You probably hate me for this, but what has been the best fund? For a balanced situation. Yeah,
look, for balanced, and we don't like throwing out the 1 year numbers, so you tend to look at some of the 5 year numbers, and certainly a lot of the corporate funds have been quite good. So the Commonwealth Bank's own internal staff fund continues to
get a job at CBA.
Yeah, basically. LG Super, which is the local government super fund up in Queensland, has been...
Is that a public offer fund? Or
No, but it's the public offer fund's been doing well lately as First State Super, and that's up the top.
Michael Dwyer will be happy about that.
Michael will be very happy with that.
Yes.
But there's, Rest continually outperforms.
It's a good performer, Rest, isn't it?
Yeah, it's very, very well run. Investment-wise, it's really done well over
Sun Super's been a good performer. Is it still a good performer?
Yeah, Sun Super's done quite well. It's dropped off in the last 12 months, but its long-term numbers are very strong. And again, don't measure funds over a 12-month period. Care Super, Rest, Host Plus, Aussie Super's done well. So most of the bigger funds have actually done quite well.
You are mentioning industry funds.
The retail funds have actually performed very well. Very well over the last 12 months. And you expect that when listed markets go forward, because they're more overweight listed stocks than the not-for-profits, who have much more in unlisted stuff.
Okay, great stuff, Jeff.
Okay, good on you.
Thanks for explaining all that.
Cheers.